If you're a retiree that lives in one of the 11 states that we're going to discuss in today's video, then there is a specific retirement tax trap that we talk quite a bit about on this channel that will be especially costly for your situation. Let me show you what I mean. Now, based on the American tax system, when you enter retirement, this is essentially what you would expect your tax brackets to look like. We have a progressive tax system, which means as you show more income, you're going to be taxed at a higher rate on that income. We have the 0% bracket, the 10, the 12, the 22, 24, 32, and so on. What can be surprising for retirees is that your tax brackets really won't look anything like that. Social Security is one of those income streams that will really transform that tax bracket. And this is because of something called the Social Security tax torpedo. Now, the way Social Security is taxed, as you show higher income, you end up moving more of your Social Security benefit into now being part of that taxable income. And so here's essentially what happens inside of the Social Security tax torpedo. As you show, let's say, an extra $1 worth of added taxable income from, let's say, withdrawing from your 401k or your IRAs, you will force 50 or 85 cents of your Social Security benefit into being taxed. And so there's a double taxation effect that happens here. $1 worth of income causes $1.50 or $1.85 to now be taxed. And so what happens is once you're on Social Security in retirement, there is no 10 and 12% bracket. Instead, your marginal rate will increase due to this tax torpedo that we have shown on the screen. Now the 10% bracket turns into 18.5%, the 12% bracket, as you see on the screen, turns into 22.2%, and then there's a new zone created with the 40.7% zone for retirees. And this is why tax planning in retirement is so important. If we can avoid these zones in a prudent way, then we obviously should. But this is just looking at the federal tax system and how the federal tax system taxes Social Security. There are also certain states that also tax Social Security. On the screen, I have 11 of these states. Now understand that not all 11 of these states will tax Social Security in the same way. And so we're not going to go through every state and talk through the taxation on a very granular level. This is going to be meant as more of an awareness video that will hopefully tee up conversations you can have with your current tax advisor. We'll give you enough information that you can explore your state taxation yourself. So when we talk about Social Security tax at the state level, what exactly does this mean? Well, again, it can mean different things for different states. For instance, a state like Minnesota has a normal progressive tax system. They determine Social Security taxability the same way as the federal government, and then you're taxed based on those Minnesota state rates. And so you'll see a progressive tax system in a very similar way from what you saw at the federal level. You'll just see that tax trap increase and you'll see those higher marginal brackets through time. Kansas, however, taxes Social Security in a completely different way. And because of the way that they tax Social Security, it creates a tax cliff. So if you live in Kansas and your adjusted gross income is $75,000 or less, you'll be fully exempt from paying tax on your Social Security benefit. Once you step over that $75,000 mark, there is a clawback effect where a portion of your Social Security benefit will instantly become taxable at $1 over that point. And so it creates this tax cliff that can be quite costly, similar to how IRMA and Medicare penalty zones are a tax cliff for retirees. And so let me show you what both of these states look like if we look at the given tax graphs within these states. And so this is a snapshot for Minnesota based on married filing jointly brackets. And as you can see with this tax graph, it looks progressive in the same nature that the federal system is a progressive tax system. The difference here is now when we start stacking on the additional Minnesota state tax. And so if you live in Minnesota, rather than seeing a 10 and 12% bracket, you see at those lower income levels, you immediately start being taxed at 28.4%, and then that gradually rises to a maximum point of 54.6%. And so again, we just see this tax trap that we previously talked about get that much more costly if you live in one of these states. For comparison, let's now look at Kansas. Remember, they're underneath a tax cliff rather than a progressive tax system. Remember that in Kansas, when you pass over that adjusted gross income level of $75,000, there's that clawback effect. So because of this, again, you see a spike in your marginal tax rate. Now this graph is shown in $1,000 increments. And so when you see a spike of 196% here, that means that that extra $1,000 that you showed in income costs you $1,960 in taxes. So if you hit the zone, you're giving away more in taxes than you're actually able to take in income. And so you'd want to avoid this if, again, prudently possible. And with married couples, the American tax system is a little bit more forgiving. You essentially have double the room in each tax bracket, you have double the standard deduction, and so typically you won't enter the worst parts of the Social Security tax torpedo if you're married until you start to show nearly 6 figures worth of gross income. Now again, there are quite a few retirees that will be pushed into those zones if they don't get their required minimum distributions under control, but again, you have a little bit more grace, you have a little bit more room before seeing those tax traps. Single filers, however, will see those tax traps at much smaller amounts of gross income. So for instance, in this example, I'm showing West Virginia and I'm showing a single filer's bracket. Now with West Virginia, they have a similar tax cliff to what we saw in Kansas. And this retiree has a $34,000 Social Security benefit. And what we'll see on the screen is the worst part of the tax torpedo. What I have highlighted here in red happens when this retiree shows about $66,000 to $81,000 of gross income. And in this $15,000 range, if a retiree would push themselves fully through this range, they would show an extra $15,000 worth of income, but they would end up giving $7,281 back in the form of taxes. So we see nearly a 50% marginal rate through that $15,000 income zone. And so this can be especially costly and cause a retiree to take a lot more than they had previously thought from their retirement assets just to pay for those taxes. And then furthermore, there are other tax hurdles that come right after the Social Security tax torpedo. So it's not as if you push through that zone and you get a ton of relief. As you see with the dotted lines on the screen, this is when IRMA starts. So IRMA is a Medicare penalty zone. And you can see that starts immediately after seeing that Social Security tax torpedo. Well, this video really amplifies the importance of having a forward-looking tax plan. First off, delaying Social Security can be quite wise because it creates a zone where you won't have extra taxable income and you can perform strategies like Roth conversions. If you identify that things like required minimum distributions or other forced income will be an issue down the road, then trying to eliminate it right now when you have the space and ability, specifically underneath these more preferable tax rates, can result in tax savings down line in a pretty big way and remove a lot of complexity. Also, if you happen to be a little bit older and you didn't do a lot of that tax planning that was so important in your early and mid 60s, and you find yourself at an age where RMDs are already an issue, well, know that if you're charitably minded, you can use strategies like a qualified charitable distribution. Rather than being forced to take an RMD and pay a 50% marginal rate on that RMD, you can simply gift that away and completely eliminate a portion or all of your required minimum distribution from your taxable income. Now, if you're wanting to know the tax implications of living in one state versus another, know that there are additional taxes you need to consider outside of just income tax. And we recently just recorded a video that talks about 5 tax considerations outside of income tax that you're likely not considering. Click on this video to learn more, and always remember, you don't need more money, you need a better plan.